Hello, friends. Welcome to the Stock Market Weekly Review from Weekend Investing uh, for the week ending 25th of April. A substantially eventful week where there was attack uh, in Belgaum and counter measures to that is causing some nervousness in the markets. Friday, we saw a deep gash in the market in the morning, but some of it was recovered by the end of the day. Likely, there will be more, uh, you know, nervousness perhaps going forward until some news of some victory for India somewhere comes through. Um, and in the last 10 odd sessions, we have come up almost 2000 points. So market anyways needs to digest that. We'll talk about that in the charts. From the research desk this week, there were all these fantastic stories. Please read the blogs. Please read the newsletters that are going daily. You can see these stories on the videos on YouTube channel or in the Weekend Investing app also. A lot of varied formats of discussions and insights are there. Do read the disclaimer fully, do understand the disclaimer fully, and do subscribe to the channel. On the Nifty daily chart, Nifty moved down sharply, as I mentioned, after 3 days of lull. The 3 days of lull was preceded by a very sharp 2000 plus point move. Um, we've gone beyond the previous highs this time, and very insightfully, if you notice, we've taken a support right at the previous high, which is a very good sign until it gets broken. If we do try to go up here and break 24,400, that will be a very, very positive sign. The next major resistance probably will come around 24,800, which was this December tops right here. So overall, the markets are, I would say, in consolidation zone. They have probably come out of a downward trend in the medium term basis. In the very short term, yes, there may be some downtrend that is possible. On the weekly chart, we are having a third week of gain consecutively. That is also showing you that there is some strength in the market. Otherwise, 3 weeks of gain in a sluggish market is not easy to come by. So let's see where this goes on the weekly chart. We have certainly broken out of a trend line, downward sloping trend line on this. S&P 500 is doing very well now, 4.5% uh, this week, and it has crossed the previous 2 week high also. So S&P 500 is giving very positive signs, and that may rub off on other markets. Gold is sluggish. Gold is down 0.24% this week, so we closed at 9654. But given the run that we've had in a year and a half, 6 months of consolidation will also not be too bad, actually, if you ask me. If we come down to somewhere near perhaps 85, 8550, that also is not too bad. About a third of what we've gained continuously is can be given up at any point of time. That is the nature of the markets. Dollar index is trying to move up. It had broken down below this important 100 mark, went down to nearly 98, is now at 99.5. I think the dollar index goes down. That is the intent of the US establishment also, to make the dollar go down so that their manufacturing, their exports can pick up. But no other country is willing to, you know, have their currencies appreciate versus the dollar. So in the next few years, there is likely to be either forced by the markets or some accord like the Plaza Accord that happened in 1985, where US and its allies sat down and US told them you will have to make your currencies appreciate versus the dollar, and they all agreed. It was Germany, Japan, a few other places. That scenario probably is difficult in today's world. Countries are not willing to compromise on their own uh, currencies for the benefit of the US. So it will be a market forces led uh, correction, if at all. And in India's case, also, if the dollar continues to drop, Indian rupee may strengthen, but then it will start to hurt the exports. Of course, it it is a positive impact on imports, but a lot of export lobby is there, and they will basically push the government, push the RBI to not let the rupee strengthen too much. So that's where the rupee dollar will perhaps hit into a roadblock in terms of going up, strengthening. Benchmark indices this week, mid cap did the best at 1.3%. Others were flattish 0.7% on Nifty and Nifty 500. Small caps 0.4%, and Nifty Next 50 was absolutely flat. So nothing really happened on the indices. Sectoral overview, IT stocks did the best this week, 6.6% for the week, 4.8% on capital markets also, and 2.9% on autos. These three were the notable sort of gainers, and media lost 2.1% along with tourism after the attack. These were the sort of big movers of the week. In the last 1 month gone by, we have seen capital markets come back 12.9%. That is a very telling sign that capital market segment is in fine fettle, going up very dramatically, leading the market. FMCG also picking up after a long time, 6.4% in the month. Banks going up nearly 6%, both private and PSU banks. Metals losing in a big way along with IT in this last 1 month. So that's where most of the damage has happened. Sectoral momentum overview, if we see, and then banking has emerged at the top now. Banking, defense, capital market, these are the ones that are ruling. Financial services was in the lead but has suddenly dropped off along with private banks. Tourism was up there, it has dropped off. Pharma is picking up in the very short term. Autos is picking up in the short term, and IT, after being languishing for long periods, is now also picking up. Real estate is also. So you can see that a huge shift in the sectoral mix is happening. Some of the sectors that have been languishing low, like public sector enterprise stocks, are not improving right now. Um, Infrastructure stocks are also not improving. You can see consumption and FMCG, which was perking up, is also slumping again. So you can see that some of these autos, IT, pharma, capital market, these are some of the sectors that are really looking good. Weekly advance decline stats. So we had 78% advances in Nifty, 64% Nifty Next 50, mid cap 58, small caps, micro cap, CNX 500 at 58. So you can see most of the advances, the bigger advances came in larger caps because the FIIs have suddenly started to buy India, and they are buying large caps. So small caps and micro caps have taken a back seat on that front. In the percentage of stocks outperforming benchmarks, Nifty is now looking much better. 70% of Nifty stocks are above uh, the Nifty benchmark. So 70% means 35 stocks out of 50 are above the Nifty benchmark for the last 1 week. Uh, in smaller and mid caps, you can see the number is much lower. Over the last 1 month, everything is just about flat. Nearly about half the stocks are above the benchmark, and half the stocks are below the benchmark, and so is about 1 year. So there's not much insight on that front. But on this weekly front, Nifty stocks have suddenly moved up. In the market cap segment, drop from 52-week high stats. Significant number of losers from 20 to 40% exist in Nifty Next 50 right here. And for small and mid caps, the segment remains 20 to 50% down, whereas Nifty 50 has significantly about 62% in 0 to minus 20% range. So the least damaged part of the market is Nifty, and you could say the most damaged part of the market is small caps and micro caps, and Nifty Next 50 and mid caps are in the middle. Is the trend improving? So let's compare how many stocks of uh, CNX 500 are above the 200 DMA, for instance. So the blue line tells you that only 28% stocks uh, are above the 200 DMA for CNX 500, which is very poor, I think, for only 28% stocks to be above 200 DMA. Of course, it is better than 13% and 7, 8, and 9% that we had earlier, but still, I think it is quite a poor sign. Maybe above 50, 60% is somewhere where market really starts to get some, trends going. On the shorter time frame, the 50-day moving average, about 60% stocks are now above 50-day moving average. It had reached almost 84%. So there is an attempt to go up. Let's see how far it takes to for 200 DMAs also to move up. In the sectoral trend check, you can see that on the shorter term 50-day moving average, FMCGs have suddenly perked up. FMCGs were not in the picture till few weeks back. On the 200-week moving average, FMCG is still at 53%, but in 50-day moving average, FMCG has perked up. Financial services has been doing all right, although here financial services has been leading the 200 DMA percentage of stocks above the 200 DMA mark. Energy stocks have suddenly come up. Energy stocks on 200 DMA are way. In fact, there's no energy stock above 200 DMA. So very sharp move in energy stocks has happened this week, and you'll probably see some numbers on the 200 DMA by next week or the week after. Private banks, 90% of them are above the 50-day moving average. Commodities, infrastructure, and the least ones are basically real estate, IT, and media. And in the 200 DMA, also you can see IT is only 10% stock. So IT, real estate, oil and gas, public sector enterprise, energy, metals, autos, all these are languishing very poorly. Where most of the stocks, uh, any I think any sector which is below 40 or 50% is actually reeling under a major downward spell because they're not even above the 200 DMA. And the only spaces where you are seeing some perk up is basically financial services, private banks, some perhaps services and FMCG sector stocks as well. FII DII stats, we are seeing a green on FII inflows since 15th of April, and that has been continuous. So that is a very positive change. Uh, the fact that US dollar index is dropping means that money is coming out of US assets and it needs to go into other assets. Just to give you a very small data point, that US GDP is about approximately 25% of the total world GDP, but the US market cap is about 70% plus of the total market cap of the world. That is how lopsided the market cap versus GDP is of the US versus rest of the world. So ideally speaking, if your GDP is X percent of global GDP, your market cap also should be somewhere near in that ballpark figure. But US is like three times more, and everything else is like one third. So a reversion to the mean kind of situation will happen probably this decade, where US markets will not be able to attract so much capital, and that capital will go into non-US assets. Maybe that trend has started. So very positive for India market, and just see that just 8 sessions of FII money coming in has caused our market to go up from 21,000 to 24,000. DIIs have been selling a little bit, not much, but also buying on occasions. So it is not the complete mirror opposite of the FII trends. And if we see the cumulative activity chart here, it will be very clear that DIIs uh, have put in 24,800 crores in the last 1 month, and FIIs have also put in 24,800 crores. So both of them together have put in nearly 50,000 crores, and there is no outflow happening in the last 1 month. Since 15th April, you can see the FI curve is going up, and DIIs have come off a little bit, but primarily you are seeing both, as they call it, the double engine thing is going on here, where FIs and DIs are both collaborating to push the market up. That's all I have for this week. I hope you will have a great weekend, and let's hope for a great market week again next week. See you next time. Bye.